What's up, guys? I just wanted to drop in and give you a quick update on what is going on with the mortgage market right now. If you didn't see my last video I released a couple weeks ago, you should check that out because it explains more of what happened at the start of the coronavirus crisis. But I'm going to jump in kind of where I left off and show you what's been going on recently and how it affects you. So there's a lot of crazy stuff going around right now. People talking about quantitative easing. What is that? How does it affect you? How is the coronavirus market affecting you and your potential to get a mortgage and what rates you're going to get? So a lot of crazy stuff. But in late February, early March of 2020, mortgage rates were at historic lows, like really low. You could get a great rate. But a lot of insecurity leaked into the overall market as coronavirus started to spread in the U.S. Rates were low, so banks started to get a huge influx of people trying to refinance and save money, like they should. Makes sense, right? But when that happens, other things are going to happen too. Huge influx. That started to combine with something else. The market was down, including something called mortgage-backed securities. Now you can think of these like stocks. It's not quite accurate, but when these are down, mortgages are worth less from an investment perspective. So on the consumer side, tons of people were applying for mortgages, but on the stock market side, mortgages weren't as valuable to investors. This, along with a few other things, meant that lenders didn't have enough money to lend all of a sudden. So rates started to jump. This is a way that lenders can compensate for all this craziness going on and make their securities more valuable. Well, the Federal Reserve saw this and decided to step in as part of the economic stimulus and start buying mortgage-backed securities. This is a process called quantitative easing. The Fed started buying so much so fast, though, that something else happened. Well, banks basically short mortgage-backed securities to protect rate locks. If you're familiar with the concept of shorting, you'll understand this. But if you're not, I suggest check out a YouTube video on shorting stocks, and this will make a lot more sense to you. But basically, what is happening is the bank is basically betting on two different outcomes so that either way they don't get hurt with any given result. But this only works if the market doesn't move too much. When the rates get locked like this, the lender attempts to safeguard themselves against minor changes against shorting, and this usually works pretty well. But when the Fed bought $168 billion in mortgage-backed securities in 1 week, many lenders started to face more margin calls, meaning that their shorts went so bad that they ended up owing a lot of money right away, like tens of millions of dollars per lender lost in a single day, up to like $100 million. This has put a lot of pressure on lenders and could cause some to potentially even go under. But since last week, the Fed has slowed down its quantitative easing program. And there seems to be news indicating that the curve for the coronavirus is flattening too. So that's good stuff. This has helped the overall market respond positively. Things have been going up the last couple days, and mortgage rates have steadied out the last few days. They haven't been having these crazy jumps, and they're starting to come down. They're not where they were 5 weeks ago, but they seem to be coming down, and they're less volatile, which is good. So whether you're thinking about buying or refinancing, this looks like a good time to get the process started. Hope this was helpful. If you have any questions, reach out to me anytime, as always. And if you're not already, go ahead and follow me on Instagram at InstaMortgageBroker. Like this video, share it with your family and friends, and I'll talk to you later. Thanks for watching. Peace.